Hello, I'm Mike Graham, president of Midwestern Securities and the host of the Banking on Growth podcast. With us today is Charlie Kelly from Remedy Consulting. Welcome, Charlie.
Oh, thank you, Mike. I appreciate you having me.
Yeah, thanks for being with us. For our listeners, will you tell them a little bit about yourself and your company?
Sure. I work with Remedy Consulting. I'm a partner, and we're a small firm, but what we do is contract negotiations, system selections, RFP work. So most of it is in the tech space. We do some things on the project side of that as well. Quick background, I came out of one of the largest core vendors in the industry, where it ran pricing and contracts for them for a few years. So, upon starting Remedy 6 years ago, we ended up hiring a bunch of folks that were in the pricing area, contracts area, products area of some of these large core vendors and digital, whether it be digital providers. And based on that, we really, our goal for our clients is really just to do everything we can to make sure that they're getting a fair shake from the vendors that they have picked out, in the tech sector.
What sectors do you specialize in?
Within the technology world, most of the banks and credit unions that you consider community banks and credit unions, they don't have their own technology department, right? The majority of them that are under, say, $4 or $5 billion in assets are they're going to be hosted by one of these large providers. So there's, they call them the big three core providers, and within that, every one of them has, kind of the full gamut of technology for the bank. Meaning they don't need a programmer. It's it's generally run out of the data center within one of those operations. So that's everything from the core to digital to, your mobile banking, to your ATMs, to, you name it, your teller line to, new accounts, you name it. It's everything inside that bank in general. So, coming out of the core provider, they handle all those sectors. So it is, I'd say we swing probably harder to the traditional cores than we do to fintechs, if that helps.
Yeah, that does help. Thank you. Where's your footprint at? Where do you have most of your clients?
Most of our clients are in the Midwest, but we are literally across the United States. We've got a sales guy out east. We've got banks across the nation, credit unions across the nation that we support. So, luckily in our world, we can be virtual. We don't have to be on site for a good chunk of it. So it allows us to have sort of an unlimited footprint.
What's happening in this space that our bank and credit union partners should be most aware of, most excited about, and find the most relevance in partnering with a consultant like Remedy?
Sure. Well, so your podcast is called Banking on Growth. I probably could speak to two sides of that. I could speak to why are these vendors important when it comes to growing your bank? And I think what I would say there is the way these contracts are written these days, because they're all inclusive, because they run your entire technology shop, they also have some kind of rather important areas that might restrict you when you want to grow. So I would say that's probably one thing. Now, that's not new. If you want to know sort of what's new in the space, I always said there's not much ever new in banking or credit unions. Right? Even the technology takes a long time to come along. But within the vendors themselves, I would say that we're seeing a lot more private equity, and we seem to be seeing a lot more vendors that are run for the financials and maybe not run for the customer support. Whether you call it customer support or whether you call it, developing the new technology, it seems like these older vendors or the larger vendors in the industry there seem to be quite a bit more focus around the financial side of the world. So the best example I can give you on something like that is when a private equity firm comes on, there's a bunch of different things that could happen, but generally it's not good for the user, right? So you as a technology user, if all of a sudden things don't work quite as well as they used to, most of the private equity firms that are out there believe they can run it more efficiently. And you know what efficiently means in our industry or your industry or anybody's, right? Efficiently generally means headcount cuts in some way, shape, or form. But the PE firms believe that they can run it more efficiently than the original owner. And so they probably can for multiple years, but it will not always be a great experience within the customer's base or whatever. Does that make any sense?
It does, yeah. The first thing people say after they sell their business is, but nothing's going to change. And the first thing private equity folks do is try to strip out costs.
All right.
And so does that mean They don't invest as much in technology. Service shifts from humans to a call center type of experience. That's kind of what you're getting.
Yeah, absolutely. Yeah, it could be the call center shifts, but more importantly, we've done some presentations that said, if somebody sunset your core or any of your vendors, how long would it take you to figure that out, right? So if they're stripping costs, how long does it take you to decide that there's nobody there picking up the phone, right? And then the other, kind of the other side of that is, even if you did know that, would you be able to, pivot in the next time your contract comes up and change vendors, or is that just too big a deal inside of your bank or credit union to do that, right? Because it is they used to call it a heart and a lung transplant, to pull all the tech out and put it all right back in. So I think that there's a lot of tolerance in this industry for, service that's maybe not top notch, but I don't know that makes it any better. And, I would argue the same thing is true if your company is run by somebody who is strictly a finance manager that is trying to make the next quarter's numbers, right? There's going to be some bad decisions, and those bad decisions are not generally going to be as good for the end user. That makes sense.
Sure. So our listeners, Charlie, are financial institution execs. So they understand who the core processors are, the players are, that sort of thing. But they're also financial advisors who sit inside of community banks. And they're also board members who serve on community bank boards or credit union boards. And they might, own a grocery store. They might be farmers.
Sure.
They don't have necessarily the same expertise and language. So I'm the president of a holding company board that owns a community bank. And so I've heard some of this, but CSI is a
provider. Yes, that's a core provider. Yeah, that's
core provider. One of the big three that you referred to.
No, they would probably be number 4 from a size perspective these days.
Okay, yeah. Who are some of the other names that you would be in?
So like Fiserv.
Okay,
historically, between Fiserv and FIS, they owned sort of 40% of the market on either side, and by that I mean one might be FIS tended to skew towards $1 billion and above. FIS had 40%, or Fiserv had 40% or more of the market in $1 billion and below. That's changing now. Jack Henry would be the third, CSI probably the fourth, and then they get a little smaller from there. But I would probably argue that service from the fours and below have historically been a little bit better because they're trying to gain market share. I don't know that it's going to be true going forward as they get larger. Like if the top 3 are bad enough where they're dropping customers, eventually, right then you'll have growing pains for the other ones. So it is, after having worked for one of these places for a while, I would say it is not an easy thing to do, right? So but that's the first thing. It is not an easy thing to do, run a company that size and have that many priorities. I think at Fiserv, we had 400 or 500 software products, right? So, and for a very early time in my time there, I worked as a project manager. And so I was in this project management team, and we would have 400 projects, at least 50 or so that had things that they wanted to get done that year, right? Of those 50, were there resources to cover them all? Never, right? So we were always juggling resources, trying to figure out which one was high priority. And even just the product groups to trying to decide which were the highest priority to be able to get the hours is a very complicated deal. So I'm not saying, that all is wrong there. It's a very tough job. But, as you talk about just how they shuffle priorities, if priority is money and not maybe loading up your project team or loading up your development team, then, you do things like maybe move development offsite. Potentially,
sure.
Sure. All those things that you were kind of talking about.
So these are publicly traded companies or private equity investors at this level in those top 3. So these contracts they're expensive, right? And they're typically long-term, 10 years, and huge breakup penalties. Is that right?
Yeah, that's a big part of it. So I would say the average is 5 to 7 years. Oddly, CSI tends to get a 10, but the breakup penalty tends to be a percentage of whatever's left in the contract. So if you sign a 10-year and you decide you're merging or you're doing something special in the middle of it, you may have a 5-year runoff, right? And the 5 years is going to be a percentage of everything you owe them from there on to the end, right? So most of them take a look at the last 6 months of what you paid. And then now that's early termination. And then you always also have to think about things like conversion fees, deconversion fees. Like there's a pretty good sized group of fees, right? That all go along with breakup. And that's, if you talk about why is this important in a banking on growth type of a podcast, I would say that it's because I always say, don't forget the expense line, number one. And then number two, anything you want to do, even if you go acquire another institution, between you getting their data over into your bank, as well as anything that goes along with what they've got going on to get out of that contract. We're matter of fact, we're working on one right now for a relatively small financial institution. He goes, I want to sell my bank because I want to retire. I can't retire. And literally the expenses for this guy who was 3 branches, I think the number's over $800,000, right? That's the breakup fee. I don't know what equity he's taking out. I think he planned to retire and take some money with him, right? But that might take a pretty good sized chunk of what he, as an owner, has an equity stake in the place.
Yeah, very interesting. So there's high stakes. How many banks go their own in this high stakes game of renegotiating and renewing, and how many would hire a consultant, and what's the upside and the downside?
Yeah, that's a great question. So at one point, now I've been out of the core game out of the large company for 6 years now, right? At that point, before I left, I had a group of people that reported to me that we had a lot of statisticians. We were keeping an eye on the consultants. I mean, we had a kind of a big role running pricing for every core within their operation, right? At one point, we had argued that it was about 25% of the banks and credit unions that did not, or that used a consultant. These days, I believe it to be over 50% on a contract over contract basis. Now, they come up only once every 5 to 7 years. And you have to remember that sometimes your core might not follow your cards. Your core might be a different provider than your digital, right? So there's multiple contracts in there, and they may not all be tied to the same vendor. But yeah, I would say these days it's probably a 50-50. And then to answer the second part of your question, why use one and why not? Let me start with the why not. Some of the larger consultants in the industry, we occasionally will come into a new bank and ask them, how do you feel? You used a consultant last time. How do you feel about that experience? And more we're hearing, boy, it feels like maybe they were getting paid by the core. Like we used them to choose a vendor, and they pushed us down a path to the point where, we weren't making our own decisions. Turns out that, as we found out later, they maybe push most of their customers to that same core. So one of two things could happen there. Like, I mean, that's not always fair to say, and certainly not, I'm not tearing anybody down, but having done enough RFPs, what you realize is sometimes the client takes you to a place, right? So they sort of start driving in a direction. It may feel like you're actually driving them, right? So there's a chance that is not exactly accurate, right? That maybe they were, that group was running down a path at the time. But then there is like, if you go out and ask the salespeople across all the industries, folks that are selling core, digital, any of them, they would say, boy, we hate it when XYZ consultant gets a gig because we never get, in our world, we never win ever. And we know who does. And it's, we can pick out the name and the number on that, right? Who gets chosen every time. So that's the downside. The positives, I think, as far as using a consultant is, there's so many things that, as I said, we hired folks that did this pricing contracts product gig within this industry for quite a few years, right? And there are so many things in this head that I can't even explain to a banker, right? What I have to do is I usually have to say, tell me what your business problem is. And then we take it from there, right? So tell me what your growth plans are. What does your strategic plan look like? And then, translate that into the way the vendor thinks about it. And then try to explain the difference between the two. By and far, they come to us because we save them money, right? Like we can compare, as a consultant, you could say, I have this many $1 billion banks. They're all using CSI as an example, right? We've been able to get this vendor to X number of dollars for that same product set, right? If you pay less, there's probably not much we're going to do to save you. But in general, if you're paying more, there are places we can get you to sort of market-based, right? So to some degree, it pays for itself. If you're just doing a contract renewal, if you're doing an RFP, it's really the knowledge of how all the products connect. What APIs look like, what all the tech builds all together. And I'll finish my answer. I know it's been a long answer to this short question, but best example I can give you is at one point we had a bank come to us, never met them before. They reached out to us and they said, "Hey, could you help us just negotiate? Like we're ready to sign. We're changing vendors. We're going to change core providers, and we just need you to help with the language here in this contract." And we looked it over and we said, "Well, did somebody help you with this?" And they said, "No." And the reason was because the software that they used did not connect to their digital platform. Never had, never will. And they were about to sign a 6-year or 8-year contract on this thing, right? If they would have gone down that path, I don't even know how you pull that back out, but you've already told one you're deconverting. You start converting the other one and it doesn't work, right? I mean, that's a multi-million-dollar mistake. And they were literally within minutes they would have signed it. They were ready to sign, and they just wanted us to come and do a little dust up on it. So, that's probably that might be an extreme example, but it isn't probably too far off. When you're doing an RFP, you probably want somebody who's seen enough of these to make sure they're filling in the gaps for you, asking the right questions.
Yeah, very interesting. When I think about this process, I really think contractual terms. I think, how can you save us some money? How can you get us better terms, shorter contract, better economics? But it's really the pitfalls that you avoid as well of the APIs and the integrations that make or break this thing potentially. That a community banker, in a 1 to 5 branch bank in the Midwest doesn't have the team probably in a lot of cases and doesn't have the global expertise to navigate all those things without this taking a couple of years. And by the time you get to the end of the process, you have to start again because you forgot what you learned at the beginning of the process.
Right. I mean, honestly, a lot of times if a client or a potential client comes to us and says, "What does this look like?" Well, a lot of times their question is just, help me with timing. Like, if I'm going to change providers, how do I think about that? And how much lead time do I need to get there? So we that's one of the first questions we get asked. And to me, because we do so many of them, it seems like, oh boy, that's a pretty, sort of a question that everybody should be able to answer. But then, it goes from there, and there's basically repetition is your friend, right? To some degree. And the other thought I have there is, I don't know that our niche is a very narrow one, right? I mean, it's one small part of banking, but because, think about this, if your CFO, the most experience they have in their career being a CFO is about a 15, 20-year run. If you only have 7 years apart in your contract, you've maybe done 3 of these in your life, right? I mean, in my job for a while there, we were doing 500 a year. So 3 versus 500 a year is, right? I mean, there's a big, and again, that was with the team and everything else, but, just the breadth of experience, I think, is probably a big part of it.
Yeah, it makes sense. Completely makes sense. Do you do other technology consulting like trust software, for example, or CRM?
Yes, we do. And if in the CRM space, I don't feel much like our team's an expert. So we generally, that type of thing, if they're looking for somebody to maybe project manage a CRM implementation or something like that, I feel pretty confident. In the CRM space, though, I know that there's folks that specialize specifically, tying your CRM to your core, tying your CRM to your database, giving advice on how to set up your sales team around the CRM. That's not our expertise. So in general, though, we've, I'd say 6, 8 primary technologies that we work in, right? So I would say that'd be digital cards, check processing, core, that type of thing. And then that goes, of course, into business online banking of some sort, something on the retail online side of it, mobile apps, and there's 25 different applications that kind of go into that path as well. So,
Charlie, we've been working with community banks since 2006, building successful, profitable, compliant retail wealth management divisions inside of the community banks. There's probably 45% of the charters in existence that there were in 2006, maybe less than that. What are your thoughts on that? And what do What does that dynamic tell you about approaching a contract renewal with a core processor?
Well, I guess what I would say is most banks have a pretty good feel for whether they're the acquirer or the acquiree or potential acquiree, right? I was giving you the example of this client that's kind of in tough shape right now. He knew 4 years ago that he was going to retire. And as you put together your strategic plan, or you put together, who's going to eventually be running the bank for you. In my opinion, a lot of financial institutions come to a point where whomever the ownership is says we want out, and sometimes that ownership might also be the CEO, right? There might be those two might be kind of combined. So I think as long as you know whether you're the acquirer or the acquiree, that's very important. And no matter what happens, it becomes really important that whatever you do as a bank does not get hindered by somebody else, right? And again, whether that's the real estate contracts you're signing or the technology contract, for quite a while there, the technology expense was third behind. I believe it was people first, real estate second, tech third. Tech might be as very close to real estate, depending upon, and sometimes it's even higher than real estate is. But because they're your partner, that doesn't mean they should take away your equity. That's why I always think you've been paying them all the way through. You pay them increases that go along with CPI. You pay them increases if you grow it. You pay them an increased price if you go acquire a bank, and that volume, used to be CSI, and now becomes a Fiserv contract, right? So they get an uptick every time. You just want to make sure that they don't get sort of monopolistic profits when you decide it's time to change, right? And whether it be, you would think the acquirers who have done a lot of it, have a very large size, would be extremely savvy about it. About how do I not get stung on the back end? But even them, they're doing only so many a year, right? And they know what they know. So I guess it's sort of inevitable that the banking space number of banks is probably going to shrink. Looking forward, I would say if you could look 4 years into the future, or 5, 6, 7, depending upon what client contract you're signing. Nobody can, but if you could, you'd probably say, boy, it's pretty. You might want to cement this thing now, because 7 years is a pretty long way in the tech space. Looking forward. And same thing with acquisitions and whatever. Even if we're just looking to buy a branch down the road or something like that. It's important. And when you see some of the back end dollars, it's even more important. The size of the dollar amounts.
Sure. What's more important? Flexibility for those unknowns and timelines and tech changes, or really drilling down to the lowest cost contract?
Well, what I could say is I believe that we do, and I'm not saying we, I would say we as consultants in the industry, right? I'm not saying Remedy, because I do believe we do a great job at it, but maybe the value of a consultant is to try to get a decent balance between the two of them. But in general, most of us has a methodology, and that methodology should say, let's talk about one of these two things first. Don't put them all together, right? Don't put your terms and conditions in with your dollars, because if you do that and you start having those conversations together, any natural negotiator is going to want to swap A for B, right? You should be able to get both, or 75, 80% of a way towards both. And again, some of that's just repetition, right? Repetition, and having worked there for a long time, I know what, and most of these vendors work the same way. I know what would give me the best opportunity to get my client a better deal on both those sides, right? Flexibility as well as dollars. So, our methodology came from just the reverse of the way we did it when we were there. I know it sounds strange, but it's 100% accurate. Like their job is be the hockey goalie, keep the money there, right? And especially being run by financial folks. There's some things like kick them on the way out the door, because you're never going to see them again, or you won't see them, and they're going to go sign with somebody else, or they're going to be acquired. That's an opportunity if you're a finance person only, right? So my point with it is be able to cover your back on both sides is not, I don't think it's undoable. The best thing I always thought a consultant do is first of all, show the methodology, show the process that has gotten best results before, try to get you to sort of market-based rates. And then in the end, honestly, it's just ask the questions or tell them, ask the questions that that vendor is going to be asking to try to negotiate better against you, and see what their answers are before you even start the process. Because if you can get some of those things out of the way and you know what's more important, because it's pretty common to ask that, do you value getting out in 4 years more than you value having a lower price? Most banks have an answer to that. Individually, they have an answer. And so that's pretty important walking into one of these things. It's very easy. It's very easy to stumble in and tell the vendor too much information.
I believe it.
Right.
I imagine a lot of times folks come in and they fixate on something that they've got to win on, and that's getting a cost to a certain number. Sometimes we see clients talk about, buying a CD. They got to get the highest rate. Well, the highest rate might be a 4-month, but rates may be dropping, and they may regret that 4-month because of the renewal rate that comes due. I was talking with a bank yesterday, and they want to stay with a vendor they're comfortable with. They were talking about a 10-year renewal, and the leadership of the bank doesn't have 10 years to walk this contract out. And I asked them, what their vision for the bank was in 10 years, and do they think this software will still align with that vision 10 years from now? And the response was basically, I'm not sure. I won't be here in 5 years. But it was a path of least resistance. And I said, well, do you think you should try to negotiate a 2-year contract that might give you more flexibility? And the response was, yeah, but it'll cost more. But it'll cost less than being in a bad contract for 8 more years.
Right. Well, the analysis we've done on that. So because we will get that question often, right? Like we think our buy time is 3 years or less, or 4 years, right? We've run an analysis that says, all right, here's termination fees, here's decode. Like we take a look at your current contract. What I typically say is, if you want a very short-term contract, most of these vendors are not going to offer you a very short-term with a lot of concessions, whether that be dollars or terms and conditions. So, and the reason for that is because historically, everybody comes a little bit early. They don't go, they're not doing this 3 months before the contract's ending. They're doing it a year and a half out. The vendors just don't have the ability to do that every 18 months. Like if you're looking for a 3-year contract, that means every 18 months we're having this conversation and you're trying to get either more discounts or, it honestly leads to a worse relationship for both of them because they're always thinking about that thing coming up the next time. So what the analysis we would do is we would sit down and we would say, based on the value of the contract today and the way we've seen early termination, deconversion fees, et cetera, this is what, here's your total cost of ownership over a 3, 4, and a 5-year period, doing it either way, either one of those ways, right? Nobody wants to take a 10-year contract, although some vendors are able to get them. Sometimes they put in and out, for within year 7 or something like that. But honestly, without being able to run that analysis yourself, and I don't think most folks are good at it because they wouldn't know the punchline at the end. How do you know total cost of ownership, right? So that sort of total cost of ownership is the way we've handled it. I don't know how everybody else out there is handling it, but just that. Here's the 3, 4, 5-year scenario. What do you think? And then take that back to the board. Let the board decide that.
So just a couple other questions for you. Community banks leadership, they have lots on their plate. Multitasking.
Sure.
They had maybe CEO, CCO, COO, CTO dealing with the Bank Secrecy Act, AML. They're frying pork chops at the local grocery store. They're doing everything. If they have limited capacity, what's the one tech project you think they should draw attention to in 2025?
Oh, good question. I think if you go to the bankers events, you see a lot of AI, right? You see a lot of digital currency, Bitcoin type stuff. If I were them, well, let me say, I've sat in on those, and I think that they're futuristic, and I think that most bank CEOs, COOs, right, don't really know what to do with that yet, right? Real-time payments has been kind of a big thing that's been coming up, but other than being a real-time payments receiver, Most of them don't have customers that are senders. So in my head, what we hear most out of our clients is because of where everybody is with liquidity, they're looking at doing a virtual branch or a virtual bank. What that looks like is more or less the same way as Fintech does it. Put a new website up, different brand, and try to get folks outside of your footprint. So what you're trying to do is get deposits outside of your footprint, where you might not be able to get those as deposits within southeastern Maine or wherever you are, right? So there seems to be quite a bit of focus on that. And then why that's complicated is because, again, what is your brand? How are you going to get business to the door? And what core are you going to use? The same one you're using today or some other better one, one that might be more flexible to do virtual only, add about 30 things to that, right? But that conceptually, I would say the ones that we get the questions about the most is how could I do a virtual branch if I wanted to? And it's been out there for a long time, the concept of being able to do it. But I think this liquidity thing has definitely stepped that up a little bit, right? How do I figure out how to get better CD? Even if I'm just offering CDs on it or something, if you offer it as People's Bank of Southeastern Iowa, right? There's not that many folks that are showing up to that site, I'm guessing. But if you call it, if you come up with a better branding, different branding that feels a little more global, now maybe that, is a little more appealing.
Charlie, what are the 2 or 3 biggest challenges that you see facing community financial institutions next year?
Well, I told you we have a podcast of our own, and I think I would probably pick out it by responses or downloads, if that's workable. Because I hate answering that question only because I don't sit on I sit on a board of a financial institution, but I am not a CEO, right? I don't ever feel like I could be sitting in that role, right? But if I look at the ones that are most downloaded, we get an awful lot on liquidity management. We do anything on liquidity, and again, these last couple of years have been really weird there, as you know, right? So that side of it, those are very highly downloaded. Commercial banking, very highly downloaded, and again, probably maybe the same reason, right? What am I doing with loans? What am I doing with deposits? From the tech side, I would say, again, we talked through a bunch of the tech pieces of it, but from a tech side, it's there's plenty going on there that they just have to deal with. And I think most CEOs would say, man, I'd rather not spend my entire day doing that piece of it because they don't love it. Most boards don't love it and don't understand it all that well. So I think they're in being afraid of it. They, when it comes up and it's time to go negotiate with that vendor, I think that first of all, they feel a little out of sorts because they don't know how and what, questions to ask all the time. But secondly, it's not their day job, right? Their day job keeps them busy as hell anyhow. So you got that, I'm busy anyway. Now I got to deal with this as a headache. And I think, a lot of times it's just, they leave some things on the table that they should be really concentrating on. So what we're hearing is, that seems to be on everybody's mind. It certainly seems to be those couple things.
The board is busy with their lives, they're busy with their careers, their families. They have lots of outside interests. They don't have necessarily expertise in this area. They have complementing skills. That's why they're on the board. They have connections. So kind of they can provide time, treasure, and talent to the institution. But it takes a few years to get good at this. So I think the answer that you gave is good. Helps maybe cut through some of the noise and focus in on some important things that could be needle movers, impactful for community financial institutions. So thank you for sharing them. Charlie, this has been really good. So I really enjoyed the conversation, getting to know you more and Remedy Consulting more. For our listeners, what's the best way for them to learn more about you or to reach out to you?
Sure. So we do have a podcast called Bank Talk. It's, again, not as a competition to yours by any means. This is more of a generic, how to educate your team. Some of our clients use it for, I got somebody who I think wants to be the CEO at some point, right? So it's a lot of general banking stuff. So there, you can go to banktalk.com to get to that material. Within remedyconsult.net is our website. And there's plenty of opportunities to reach us there. So always love to hear from folks. And even if it's just hey, we're thinking about doing something. What are your thoughts? I don't ever believe we win 100% of the business that we go after. And I don't try, our goal, we don't try to. That's not really what we try to do. We try to be advisors wherever possible. And we just figure, if in doing that, we'll make our money at some point. And we're not strictly financially focused. This is such a weird, complicated game that a lot of times just answering a question for somebody, they'll love you and remember you next time. So
do the right things for the right reasons, and
hopefully,
the chips fall where they fall.
And I wanted to say thanks, Mike. I appreciate you having us on here. This has been excellent. I love the questions. I love your approach to it.
Oh, thank you. I've really enjoyed it as well. And for all of us at Midwestern Securities in Banking on Growth, thank you again, Charlie, and thank you to our listeners. Until next time.
This has been another insightful journey with Banking on Growth with Michael Graham and Midwestern Securities, a member of FINRA and SIPC. We appreciate your time. If you found value in today's discussion, consider subscribing for more thought-provoking discussions in the world of finance. Your support helps us continue to bring you quality insights. If you have a topic you'd like us to consider covering or have thoughts on one of our episodes, we'd love to hear it. Just email us at media@midwesternsecurities.com. Remember, the power to grow is within you. Thank you for being a part of the Midwestern Securities community. Until next time, stay inspired and keep banking on growth.